Differences between private equity and venture capital. Hey, welcome back to another episode of our daily education on finance. Today, we'll be discussing private equity and venture capital. In what ways are they similar? In what ways are they different? Before we dive in, make sure to like and subscribe. You wouldn't want to miss out on all our excellent content. So, before we can differentiate between private equity and venture capital, we must first know the meaning of these two. There are different types of funds of which private equity and venture capital are a part. We also have other types of funds like the hedge fund and the real estate fund. Now, what is private equity? And what is venture capital? A private equity fund can be defined as a collective investment mechanism that pools funds from various investors with the ultimate goal of acquiring stakes in entities. Thus, private equity, or PE, is a collected pool of investors who come together to invest in businesses. They raise funds from personal funds, insurance companies, and wealthy individuals and invest that money in companies that they think will generate a greater profit for them. Private equity firms purchase business interests on behalf of investors who have already put up the capital. Private equity also refers to investment funds, generally organized as a limited partnership that buys and restructures companies that are not publicly traded. Private equity is an investment business. It is an alternative form of private financing. Private equity is a prevalent form of investment, and mega investors like the Yale Investment Office, Canada Pension Plan Investment Board, and the Nikola Wealth Management Team companies are known to have a sizable allocation of their capital in private equity. The Canada Pension Plan Investment Board invests in private equity directly and indirectly, and it has 23.7% of its capital in private equity. Various wealth managers are also pulling their investment capital together to get access to private equity funds. The Nikola Wealth Managing Corporations in Canada currently have a 40% allocation to private equity, private debt, and infrastructure, and they are looking forward to increasing it to 50%. Venture capital, on the other hand, is a form of private equity and is a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Venture capital generally comes from well-off investors, investment banks, and other financial institutions. Venture capital is capital allocated to small companies with exceptional growth potential or to companies that have experienced rapid growth and seem poised to continue to expand. Venture capital financing is funding provided to companies and entrepreneurs. It can be provided at different stages of their evolution, although it often involves early and seed round funding. In addition to these, venture capital funds manage pooled investments in high-growth opportunities in startups and other infant firms and are only open to accredited investors. Entrepreneurs often go to venture capitalists for money because their companies are still new and unproven. And unlike other forms of financing where entrepreneurs are only required to pay back the loan amount plus interest, venture capital investment commonly involves a portion of ownership in exchange for funding. This is to ensure that they have a say in the future navigation of the company. Not all venture capital investment occurs when a company is first founded. As I mentioned earlier, venture capitalists can provide funding throughout the various stages of a company's progression. Private equity and venture capital are also similar in some ways. One of the similarities between private equity and venture capital investments is that they both raise pools of capital from accredited investors known as limited partners, and they both use this capital to invest in private businesses. Moreover, their goals are the same, which is to increase the value of the companies they invest in and then sell them or get profit from them. Now, what are the differences between private equity and venture capital? Although it's unequivocally seen that these two investment techniques are related, there are so many factors that differentiate them from each other. One of the numerous distinctive factors that differentiate venture capital from private equity is that, technically, venture capital is a form of private equity. And while private equity firms are looking for stable companies, venture capital investors mostly come in during the startup or foundation phase of a company. The venture capital fund is usually given to corporations with incredible growth potential. Venture capital investments fund and mentor startups, while private equity firms typically invest in established businesses that are deteriorating because of inefficiencies. The assumption is that once the inefficiencies are corrected, the companies could become profitable. At this point, the private equity firms may now decide to buy these companies. Also, when we look at the funding structure in both funds, we can see the difference between them. The funding structure in private equity deals with equity and debt, while that of venture capital is concerned with only the equity of the business. Furthermore, in private equity, a private equity firm will make returns when they exit their investments or sell companies for a higher price than what they paid to buy them. In contrast, venture capitalist investors make returns when cash or money is returned on liquidity events. Another factor that makes private equity different from venture capital is the exit strategy in both investments. Each of these investment funds has a unique exit mechanism that it uses in its investments. Most of the time, private equity investors look to improve a business and then turn it around for a quick sale. As a result, they are not interested in being involved in the industry for a long time. In comparison to this, venture capital investors are interested in the long-term growth of the company. They want to gain a substantial amount and are bent on sticking around until that happens. In addition to this, when we talk about control of the business, the two funds differ. Private equity fund investors require a majority stake in the company. That is, it can control most of the company's decisions, whereas venture capital investors only ask for a minority stake in the company. Generally, PE and VC buy different types of companies, invest different amounts of money, and claim different parts of equity in the companies in which they invest. So it's therefore evident that one of the important things that separate private equity from venture capital is the amount each claims in a company after investment. The investment scale in both funds also differs. A venture capital firm likes to limit its investments since each startup it invests in is at a possible risk of failure, meaning that even though these companies succeed, they might not work in the long run. Conversely, a private equity firm may put large amounts into its investees on the grounds that these more established firms are unlikely to go bankrupt, which reduces the risk of loss in PE. Equally, a venture capital looks for a high-grade management team which it can rely upon to create a high-value business, and a private equity firm looks for undervalued assets which it can use its expertise to enhance and grow. All these and so many factors differentiate private equity from venture capital. I hope that this video has been educative as you expected and that it has enlightened you on the differences between private equity and venture capital funds. Make sure to like, subscribe, comment, and share before you go. Thanks for watching this video. See you next time.